All right, welcome to the Explainer. Today, we are going to break down one of the most powerful forces out there, something that literally shapes your wallet and the entire national economy, monetary policy. Now, I know it sounds super complex, but stick with me, and by the end of this, you'll get exactly how the whole economic ship is steered.
So let's kick things off with this definition right here. It really gets to the heart of it. The whole game is about controlling the flow of money to keep our economy healthy. And those key phrases, price stability, growth, financial stability, that's exactly what we're going to unpack.
So to get our heads around this, we've laid out a simple roadmap. We're going to start with the absolute basics. Then we'll look at the tools they use, and we'll wrap up with a part that matters most, how all of this actually affects you.
Okay, let's dive right in. Section 1. What is monetary policy? When you boil it all down, what is the system really trying to do?
At its core, it's all about managing something called liquidity. Just think of liquidity as the cash that's flowing through the economy's veins. If there's too much, you get problems. If there's too little, you get other problems. The whole goal is to get that amount just right. And that brings us to Section 2, the Economic Balancing Act. This is where things get really interesting, because managing that money supply, well, it's like a constant juggling act.
Okay, so picture this. On one hand, the central bank has to keep inflation in check. That means making sure the price of everything, from your groceries to gas, doesn't just spiral out of control. But on the other hand, it has to make sure the economy is growing, creating jobs, and keeping the whole financial system from falling over. And if you pull one of those levers too hard, the other one can get thrown way off balance.
And this isn't just some vague idea, right? There's an actual number. The RBI has an official target, and the sweet spot is 4%. But there's a little wiggle room, plus or minus 2%. So basically, an inflation rate anywhere between 2% and 6% is considered the ideal zone for the Indian economy. Now, this leads to a super important point. You might be thinking, wouldn't zero inflation be perfect? And it sounds good, but actually, no. It's a bit of a myth. Zero inflation can mean the economy is totally stagnant. A little bit of healthy inflation, like in that 2 to 6% range, actually nudges people to spend and invest, and that's what keeps the economic wheels turning. So the big question is, how does the central bank actually pull off this balancing act? How does it pump money into the system or take it out? Well, let's open up its toolbox and take a look at the instruments of control. The big one, the main tool you'll hear about all the time in the news, is the repo rate. You can really think of it as the master switch. It's the interest rate that the big commercial banks pay to borrow money from the RBI. And because of that, it ends up influencing pretty much every other interest rate in the entire economy. And what's really cool is how you can see this clear domino effect in action. Let's just walk through it. First, the RBI raises the repo rate. That makes it more expensive for banks to borrow money. So what do the banks do? They pass that extra cost on to you, making your home loan or car loan more expensive. Naturally, people start to borrow and spend less. And then, voila, with less spending, demand cools down and inflation starts to drop. It's a perfect chain reaction. But wait, there's more. The repo rate isn't the only tool in the shed. The RBI has other heavy-duty instruments too. For example, it can change the CRR, which is the amount of money banks have to park with the RBI. Or it can conduct open market operations, OMOs, which is basically just buying or selling government bonds to either inject or, get this, suck money right out of the system. Each one is another knob they can turn to fine-tune the economy. Now, using all these tools isn't just some random button pushing. It's all part of a much bigger strategy. These decisions are thought out really carefully, and they signal the central bank's next moves to the entire market. So let's look at the different game plans the bank can run. It really just boils down to two main stances. When the economy is slowing down, the RBI can go with an expansionary or loose policy. That means cutting rates to make borrowing cheaper, basically hitting the economic accelerator. But when inflation is getting too hot, they switch gears to a tight policy, raising rates to slam on the brakes and cool things down.
And within those strategies, you'll hear people use these bird-themed terms. A hawkish stance is super aggressive. It means they are laser-focused on fighting inflation no matter what. A more dovish or neutral stance is more balanced. It's like they're taking a patient, wait-and-see approach, keeping an eye on both inflation and growth.
So who actually makes these huge decisions? Well, it's not just one person. It's this group, the Monetary Policy Committee, or MPC.
It's a team of 6 members, and they meet up every 2 months to vote on what to do with the repo rate. What's fascinating is how it's structured. 3 members from the RBI and 3 appointed by the government. It creates this really interesting balance of perspectives.
And that brings us to our final and maybe the most crucial section. We've covered the what, the why, and the how. But now for the big one. How do all these high-level decisions actually ripple out from that committee room and affect the markets, the economy, and ultimately, your life?
Let's just walk through a scenario. Imagine there's a sudden shock, like global oil prices just shoot through the roof. The RBI would immediately jump in with its tools to try and stabilize everything. That action would cause shifts in the financial markets, impacting things like the yield curve, which is really just a snapshot of interest rates. And this all happens alongside government policy, which helps make sure everyone is being financially responsible.
Okay, but let's cut through the jargon for a second. Yield curves, policy stances. What does any of this really, truly mean for your day-to-day? What's the direct impact on you, on your job, and on your savings?
This right here is the bottom line. Every time the repo rate changes, it can directly affect your home loan EMI. Every policy put in place to fight inflation can have an impact on the job market. In that goal of price stability, that translates directly to how much you're paying for groceries every week. So while this whole world of monetary policy can feel a bit distant, its effects are right there in our everyday financial lives. That's all for today. Have an amazing day, and don't forget to like and subscribe.